This is actually one of my favorite topics to talk about. And I thought I'd kick off with an old photo. So I started on the trading floor when I was 18 years old. But growing up, I've always associated making more money with working harder, right? Essentially, I believe that in exchanging my time for value. And what really gets me excited about investing is that kind of breaks the relationship. So to give you a couple of stats, in New Zealand, the average wage growth over the past decade or so has been around 3% per annum. In contrast, when you look at the long-term returns of the stock market, that's been around 10% on average. Now, it certainly fluctuates a lot, and we'll be talking about that, but it gives you an idea of actually the returns that, or what you do with the money, when you fight so hard for a pay rise or a promotion, can be just as important, if not more important, than fighting for that pay rise or promotion. So I'm excited to dive into the world of investing today and also specifically apply the lens of investing on behalf of your child, which is a bit different. So I started on the journey to Crayon around 4 years ago when I welcomed my older daughter, Louisa. That's my younger daughter, Madeline, on the screen too. And what I found was that even though I had studied finance and worked in finance, there was a lot I still didn't know about finance as it related to parenthood. There were just a lot of unique puzzles that we don't really talk about, and certainly no one told me about. And so about a year ago now, we launched Crayon, and we're really trying to build the home of parenthood and money, specifically in New Zealand. When I think about my kids' futures, I think about the opportunities I want them to have, and you might be in the same boat. And that's where investing can play a vital role. And our mission at Crayon is to reduce financial stress for parents. And again, that's where I see investing, particularly in the long term, as a way of doing that, and particularly opening up the horizons for your kids. I think as much as we don't like to talk about it or admit it, sometimes what is available for our children can depend on our financial circumstances. So we're going to cover 4 things today. The first is putting on your oxygen mask first. The second is why think about investing for your child. The third is, getting some parameters around what it could be worth when they're older. And then the fourth is, if you want to go down that path, how do you think about choosing a good investment? Now, a legal disclaimer is a standard routine of any presentation that covers investing, and for 2 good reasons. The first is that investing does involve risk. You can make money, you can certainly lose money, and it is something we're going to talk about here. And the second is there is no universal one great investment for everyone. What's right for you will depend on your personal circumstances. So as a result, we're very careful not to make product recommendations, because what's right for one person may not be right for the other. So whenever you watch an airplane demonstration for safety, they always talk about putting your oxygen mask before tending to a child. And the same applies here when it comes to investing. So the first one is debt. So do you have any debt? If you don't, happy days. So no mortgage, no credit card, no personal loans or student loans, then, parts go. I think for most of us, and myself included, there is some form of debt, particularly at this age and stage of life. The next question is then, well, how much do you pay on that debt? And above 7% per annum is considered high interest debt. And that's why if you have that, and typically credit cards are a really good example, they can charge, upwards of 20%. Car loans are also another good example. In that case, the generally accepted principle is that you pay that down first. And the reason is that it's really hard to reliably generate 7% returns after tax every year. And there also are non-financial reasons, right? You might feel better getting rid of that debt. But if you have debt that's under 7%, now mortgages are typically a good example of this. There's no black and white answer. We have a really great article on our website called Should I Pay Down My Mortgage or Should I Invest? And it goes through the financial and non-financial reasons why each of those options might make sense for you. It's not cut and dry. So I really encourage you to go on. It's actually accompanied by a calculator, so you can see the numbers, but it also has the emotional side to it, right? Getting rid of that mortgage sooner might be really important for some people. So it's not cut and dry. But in general, if you've got high interest debt, that should be prioritized first. So that's your first oxygen mask. The second is an emergency fund. So with kids, there just tends to be more unexpected expenses, a ball through the window and suddenly you've got to get a new window pane. Or in my case, both my kids ended up having, one had an allergy and one had a skin condition, which we didn't expect. And off we went to the specialist. And there are just extra expenses that we hadn't anticipated. And I think that's the case for most parents. And that's why an emergency fund can give you a cushion. If you don't have one already, start small, right? $20 a week over a year will get you to $1,000. Then start to think about, okay, well, how many months do I want to have as a cushion? Generally, that can range between 3 and 6. Now, some people are more comfortable towards 1 month. Some people want more, 12 months. That's a personal preference. But think about, look, if I couldn't work tomorrow, if I lost my job or I had a health issue, what would I need so I could keep the roof over our family's head? And, maybe I would cut back some expenses, but, hey, I still need to feed the kids. Maybe there are some things I don't want to compromise on. What's the number for me so I can sleep at night knowing that my family has some sort of cushion? You want to keep this readily accessible, right? The moment that you need it, you need to be able to know the value of it and be able to pull it out straight away. And that's why cash in the bank is a great place for an emergency fund. If it's in an investment, and we'll look at this in more detail, it can fluctuate up and down. So what you don't want to happen is that the moment you happen to need it, it's down. And that's why this money is best kept in cash. And the third and last oxygen mask is your KiwiSaver. Now, this is a type of investment, but it's specifically for retirement. And as a result, there are very strict rules. You can't touch it before you're 65 years old unless you're using it to buy your first home, or there are some other reasons, like you hit financial hardship and you have to make an application and prove that. You leave New Zealand forever, so you're not planning to retire here. There are a couple of exceptions, but they're not usually part of the course, your daily course of life. So the reason this is on as an oxygen mask is you get matching money. So every year, the government, for every dollar that you put in, they kick in an extra 50 cents. And that's capped at $521. So to maximize that, you need to put in $1,042. That year is measured from the 1st of July to the 30th of June. So you might have received a reminder from your KiwiSaver provider saying, hey, the deadline's coming up. Do you want to make the most of this? You don't often get free money from the government, so try to make the most of it. And the second is that employers are required to match 3%. So you kick in 3, they'll kick in 3. And again, they're essentially doubling the money. There is a little bit of tax, but you do get most of it. And again, with an investment, you're very unlikely to double your money. So at least in a short period of time. So that's why it's great to make the most of what your employer will kick in as well, which is why this is listed as an oxygen mask. So they're the 3 things to kind of check off before you start other types of investments. So why invest for your child? Growing up, one of my favorite game shows to watch was The Price is Right. So I thought we'd play 2 lightning rounds. And the first one, and I'll throw up a poll in a minute, is your teen and early adult child. Let's say they want some wheels to get around town. They need a digital device. And let's say they want to go to university. I know that these things are not essential for everyone, and certainly your child may take a different path. But for the sake of the game, estimate how much this will cost you. And I will just bring up a poll so you can have a look. So what do you think? Have a guess. What is your teen and early adult likely to cost you? Doesn't have to be precise. I'll flick the screen back again. So it's a used car that's 10 years old, a laptop, and a 3-year degree in New Zealand. Okay. So It totals $42,000. Now, like I said, you may not want to do any of these things for your kids, but I think the general point is that there are some pretty hefty expenses that may come up that you might want to be in a position to help your child with. Which brings me to the next round, which is your adult child. So the average age a child wants to leave home these days is 27. So, they could be with you for another 9 years of groceries and utilities. Maybe they want to get hitched and you want to be able to kick in a quarter of the cost. And maybe they want to buy a house, and we know how expensive that is. So what would a quarter of a 20% deposit for an average or median house price in New Zealand cost? I'll give you, 20 seconds to have a guess. It's just a bit of fun. What do you think that would cost? Okay. Yep, so $73,000, I think the general point here is you might think, oh, they turn 18, they leave home, it's not my problem, not my financial problem anymore. But actually in New Zealand, 1 million Kiwi parents are supporting their adult child financially in some form. So, it is, and even if they don't need it, maybe you want to be in a position to help them. Like you want to be able to celebrate a great wedding with them or what have you. Or maybe they want to start a business and you want to provide a bit of capital, or they want to travel the world and you want to kick in a bit so they can have amazing experiences. It will look different for you and your family, but the general point is there's probably something coming up in, 10, 15, 20 years that, related to your child financially that you might want to start investing or saving for. So, of course, the $1 million question is, what could it be worth when they are older? And although nobody knows, and anyone on TV telling you otherwise doesn't know either, but we can look at some historical information for guidance at least. So with investing, there are only 3 things that determine what it's worth: how long you invest for, how much you put in, and the returns that you earn. And obviously they can go up and down. So there's not that much you can do about returns, right? You can't influence the stock market or set interest rates or things like that, but you can control 2 of the factors, right? When you start investing and how much you put in. And there is still a way to influence your returns. So even though there are hundreds of thousands of investments out there, they all fall into one of 5 categories, and they can be mapped on this graph. So on this axis here, I have the potential return. And on this axis here, I've got the expected risk. So something like cash, very little risk. You expect the bank to still be there and for your money not to go down. But as a result, the return that you can generate on cash tends to be relatively lower to other assets. Then you have what we call fixed interest or bonds. So the best way I think about this is you are lending money. So you're the bank. You're lending money to a corporate or to the New Zealand government, and they're paying you interest. So it's still a little bit riskier than cash, right? Because a company can still go bankrupt. But generally in the pecking order, you're at the top. If it goes bankrupt, you get paid out first. So as a result, it tends to be, slightly more risk and slightly higher return than cash. Then we have property, which is an asset class a lot of Kiwis are very familiar with. Obviously, you can, own your own home. And in that case, you're hoping that the value of that home will go up, or you can buy an investment property, in which case it's not just the value of the property, but also the income that you can generate through renting it out. Then you have shares. So I think about shares as, when you buy 1 unit of a share in a company, you become an owner of that company. That's just, legally that's definition. So when you go buy 1 share of Air New Zealand, you hold a tiny, tiny, tiny part of Air New Zealand. So the value of those shares will kind of rise and fall depending on the fortunes of that company. And it can also be influenced by the broader market. And then lastly, we have a catch-all bucket called alternative investments. Now, they tend to be very risky, very speculative, and it's things like collectible sneakers, collectible artwork. Crypto would definitely fall into this bucket. If you've ever heard of derivatives or options, it is a catch-all, but they tend to be a little bit more esoteric and not mainstream. So the three asset classes probably most familiar to Kiwis are cash, property, and shares. So my next quiz for you is, over 20 years, which of these three do you think have performed the best? I'll throw up the quick poll here. Let me have a quick look. Apologies, my poll hasn't loaded. So have a think. For a lot of folks, we hear about property a lot, right? And yes, it's done well, but actually over 20 years, shares have done much better. So this is a chart. If you had invested $100 back in 2002, what would that have looked like? And I think a lot of people find this chart surprising because we hear about property so much, and and people like it. I understand that. You can feel it, and that brick is not going to disappear, or that piece of land's not going to disappear. But actually, when you look at it from a financial perspective, shares have outperformed historically. So we talked about, well, what are the things that can influence, that you can influence, right? There's not much you can do about the returns. You can pick the asset, and that does influence the risk and return, but ultimately you're at the whim of the market. But you can control time. And I love this example because let's say we've got little Mia and little Tom, and both of their parents do the exact same thing, which is they invest $100 a month. Now, the only difference here is that Mia's parents do it between her when she's 5 and when she's 15, and Tom's parents do it when he's 15 and 25. So they both do it for 10 years. So they're both putting in the exact same amount of money. The only difference here is timing. And what you find is that this is assuming a 7% return, but when they both turn 25, Mia actually has double what Tom has, just because her parents started earlier. And that's the joy of compound interest, which is a term you might have heard about. But essentially what that means is, because you leave it there for longer, your returns earn more returns, etc. And that's just a factor of time. And so that to me says, okay, if your kids are young, this could certainly be something to look at. The other thing I touched on is that investments can fluctuate a lot. And this is a graph of the stock market from 1958 to recent history. If you pull the history back even further to like the 1920s, the graph looks very similar to this. And the dark blue patches, they're what we call bull markets. That's when the market's doing really well, it's going up, happy days, making money. And then the orange bits are what we call bear markets. That's when the market is going down, you're losing money, not great. And what's interesting is our human brains are programmed to think about the negative things and to remember them. It's kind of, our lizard brain from thousands of years ago, from a survival perspective, remembers the bad stuff. I bet that you could name some of those negative orange parts, right? That's COVID. That's the global financial crisis in 2008. That's the tech bubble bust in 2000. That's oil crisis back here. So, there are no names for the blue periods. We don't name them anything good because we just remember the bad stuff. But I like this because it shows you that, on average, bull markets last 6.6 years, and the cumulative return for a single bull market is 340%. Bear markets, on average, they last 1.2 years, and the cumulative negative return for a single bear market is around 40%. So you can certainly lose money, right? You look at this part here in the GFC, your investment could have gone down almost 60%. So it really does show that in the short term, it's highly unpredictable. But in the long term, you can see that it comes in cycles, right? It's, look on average every 7 to 10 years, there's a big downturn. Again, no one knows when that is going to happen exactly, and we're in a downturn at the moment, and we don't know when we're going to come out of it. There are always people making predictions, but the truth is nobody knows, right? Nobody could have predicted COVID, or at least when it happened. So that's why when you think about your children and their long-term futures, you have the ability to ride out some of these down patches and really benefit from the up patches. So what I want to show you is we've built an investment simulator. And I did this because often when you look at calculators, they say, oh, just assume 7% return. And that's kind of helpful. But I think as a parent and as an investor, I want to know, well, what's the probability I'm going to lose money? And if it gets bad, how bad is it going to get? And if it's good, what does good look like? And again, although we don't know what the future holds, we can use a lot of that historical information to get a rough gauge. And that's what the purpose of this is. So you can download this on our website. And I'll just flash up an example. So my older daughter, Louise, is now 4. Let's say I want the money when she's 20, for whatever life may hold for her at that point in time. And right now, what I can put aside is $100 a month or $25 a week. So we took historical information from 1988 to 2022, so 25 years, a good chunk of time. And I looked at, okay, if I picked the worst possible month to invest, the very worst, I was just super unlucky, what would that look like? Well, what this tells me is over the 16 odd years that I'm investing, I've put in $19,200. That's the same across every scenario. And I would have lost money, right? That's if I'd just been super unlucky and I picked the very worst day. I would have lost $1,100 and I would have been left with just over $18,000. So not great, I've lost money, but most of the money is still there. Obviously, it's gone worth a bit less because of inflation, but it hasn't gone to zero, right? Which is, I think, one fear that we have. And this is looking at the S&P 500, which is largely representative of the US stock market, and most of the global markets move together. Then I think, okay, well, what would have happened in 95% of circumstances? So most of the time, the vast majority. Well, actually, in 95% of the time, I would have made $6,800 and my daughter would have $26,000. That's pretty great, right? What happens on average 50% of the time, Well, in that case, I would have made $20,000 just over, and she'd have close to $40,000. We go back to how much would things cost, whether that's the uni degree or the wedding or the travel or what have you. That's a great nest egg. That really gets her on her way. And then if I'd been super lucky, I just happened to pick the best month. I didn't know it at the time, but let's say I had the very best return you could get, then she would have made almost $50,000 and it would have been worth close to $67,000. And the last stat I have here is if you had invested in any month over that 25-year period, what's the probability if I had held that investment, if I put in money every month, that $100, and I had held it for 16 years, I didn't sell it, I didn't touch it, only in 1% of cases historically would I have lost money. Now, anything can happen in the future, but I think when you look at cycles, this at least gives you a gauge of how good can it get, etc., and how bad can it get. So feel free to download this on our website. When I send the recording to you, I'll include a link to it and just have a play. You can see here that if I want my daughter to access it at 10, maybe I want to use it for something else much sooner, you can see that actually the returns are a bit lower, but also they can fluctuate quite a bit more. And that's to be expected because as we touched on, it's a lot more unpredictable in the short term, but more predictable in the long term. At least that's what the data has been for the last 100 years. So that's something we've built and hopefully you find that useful. So the last question we want to cover today before we open it up for Q&A is how do I get on the path to choosing a good investment for your child? And there are 5 decisions. I kind of call it pick your own adventure or choose your own adventure. The first one is what investment strategy do you want to have? And there are 2. You can either pick a fund or you can do it yourself. So a fund is where you give the money to a professional investor who makes decisions on your behalf. The benefit of this is they're getting money from lots of different investors and then they're making decisions for everyone. So when you buy into that fund, you instantly get access to all the investments they have. So an example is if you buy into a New Zealand top 50 stock fund, you get instant exposure to all 50 stocks, right? And diversification is important because while the stock market in general might trend up. A single company can still go bankrupt, right? And I think you can think of some, off the top of your head. Companies do go broke, but it's unlikely that all 50 companies will go broke, which is why diversification can really help weather some of those losses. The second is it's relatively low effort. You do have to do the work to find a good fund, but once you do, the manager makes all the decisions. You can kind of set and forget to a large extent. There are lots of different types of funds. There are broad funds. You can even invest in all share markets across the world. There are funds that will do that for you. You can invest in the New Zealand stock market fund, or the US, or Australia, or Europe. You can invest in sector-specific funds. So that might be, hey, I really believe in clean energy, or I really believe in healthcare, as an examples. And now there are more and more ethical funds, or ESG funds. That stands for environmental, social, and governance. So, hey, maybe I don't want to invest in fossil fuels or weapons, or, often when you think about investing for your child, you also think about, well, what kind of world do I want my child to live in? And I want my money to kind of follow what I believe in. And there are more funds that allow you to do that. So, because someone is doing the work for you, you pay them an ongoing fee, and that ranges from 0.05% to 1.5% a year. So that's the leakage really that you pay. The flip side is you can do it yourself. You decide which companies you want to own. You decide when to buy them, when to sell them. You can diversify, but you've obviously got to do the work to find multiple different funds or multiple different stocks, I'm sorry. So, if you buy all the stocks in New Zealand, you might not have exposure to the US or to, other markets. It's relatively high effort. You've got to do the research, you've got to monitor it, you've got to decide when to buy and sell. The good thing is you can pick exactly what you want, so you can avoid the things that you don't want in your portfolio. And the fees, generally you pay when you buy and sell. Now, some platforms such as, I think Sharesies recently introduced a monthly fee. It's a couple of dollars a month, but generally speaking, most of the fees come from when you're buying and selling. So if you're buying and selling a lot, you will rack up fees. Look, if you're just buying and leaving it to do its thing, then it's actually relatively low cost. So then the second decision is, if you go the fund route, do you want an active fund or a passive fund? So an active fund, that's when you're relying on the judgment of the professionals. You want them to do research, have opinions, pick which stocks are going to be the winners. That's kind of their job. And so you would take this route if you believe that an active fund manager can outperform the market year on year. Because someone is putting a lot of work into all the research, you pay them higher fees. It's on average about 1.2% in the New Zealand market. The other type of fund is a passive fund. You just generally track the New Zealand market, or you just generally track the US market. You are never going to beat the market by definition, but it tends to be lower fees, about 0.5%, because it's mostly administrative, right? There's not someone doing lots of research on which stock is the best. You're just broadly following a fund or a market. Now, there's no right or wrong answer here. I personally sit in the passive fund category. My husband sits in the active fund category, and we both know a lot about the share market. So it's not that there's one that's superior to the other. And there are you can find people who will make the case, but there's no right or wrong answer here. The third decision is, well, what vehicle are you going to use for a fund? So there are two types. You can have KiwiSaver or a general fund. So KiwiSaver, because it's designed for retirement, if you set it up for your child, they can only use it for retirement or to buy their first house, etc. Now, some people like this route because it is so restrictive. Your child can't go blow it in Vegas, or do something with it that you don't want them to do, or that you would consider irresponsible. But it is locked up. The flip side is a general fund. And that means once they come of age, generally the fund will set it somewhere between 18 and 25. Your child can do whatever they want with the money. Now that can be exciting too, right? Because that means they could fund their education or travel overseas, etc. But again, they can also blow it on things that you may not want them to blow it on. So this is a trade-off really in terms of control that you have, or that they have, over the money. The fourth decision is, if you go the general fund route, you can choose an unlisted or listed fund. So a listed fund, it's on the stock exchange. It trades like a share. There are buyers and sellers, and that you can trade anytime the stock market is open. But for kids, the really important thing to note here is that ETFs or listed funds are taxed at the very highest tax rate of 28%. That's the default for everyone. Now, you can claim a tax credit, but that's only useful to you if your child has income to offset it. And most of our kids probably aren't earning income for quite some time. So there is a tax leakage for most parents if they're investing on behalf of their child with ETFs. Now, some people like it because you can see it and you know that you can trade any day. Or the unlisted funds, well, the trading is determined by the fund manager. In New Zealand, most of them are daily, right? So it is still relatively easy to touch your money, but that's something you want to check before you invest in the fund. The upside of this is that you get to be taxed at your child's correct tax rate. And the lowest tax rate for a child or for anyone is 10.5%. So there is a differential here to think about when you're investing for your kid. And then the last one is, well, whose name is it under? Is it under your name or your child's name? So if it's in your name, you have more control, right? It's essentially still your investment. It's just you kind of earmarked it in your head for your kid. That means if you have more than one child, you can kind of use it as your needs of your children kind of go up and down, as opposed to having a fund for every child. And look, if you hit hard times, you can dip into it. It is, however, taxed at your tax rate. So if you're generating an income, that is probably that might be a higher tax rate than what your child who's not generating an income. And it's still subject to claim. So if you go bankrupt, your creditors could come after the funds. If you split with your partner, it could be considered relationship assets and you might have to give half over. And if you pass away, you'll need to specify in your will that that investment account goes to your child. Otherwise, it could go into your general assets and be distributed according to your will or according to the law. So there is the risk that the money may not make it to your kid. Now, the flip side is that if you put it in your child's name, once they come of age, and again, that's between 18 and 25, depending on which platform you use, it's their money. They can do whatever they like with it. It is, however, taxed at your child's correct tax rate rather than your tax rate. And it's in your child's name. So if I put it in my daughter Louisa's name and, let's say I'm subject to bankruptcy claims, my creditors can't come after that money. It is ring fenced for her. And that's an upside of putting it in your child's name. So again, it's a trade-off, right, around how much control you want. There is a third option, which is putting it in a trust. Now, you might have this if you have a family home or for another reason. You will have seen perhaps last week in the budget announcement that the tax on trust rates is going up to 39%. Whether this is the right vehicle for you is something to talk about with your lawyer and accountant, but that's a third option there. So you won't need to make every decision for every strategy. So let's say for DIY, you can miss all the fun decisions here, 2, 3, and 4. Your only decision is whose name is it under. If it's a KiwiSaver that you want to do, you'll need to decide whether you want to have a passive KiwiSaver or an active KiwiSaver. You'll probably want to put it in your child's name because you want your child to be able to use it for their first home deposit. Whereas if you put it in your name, you can only touch it when you retire, and that might not align with your child's timing. And then the third is if you go the general fund route, you've got a few more decisions, right? Active, passive, listed, unlisted, your name or your child's name. So these are the kind of things that are different about investing for your child. You'll need to also think about, how long you're investing for. If you're investing for a shorter period of time, generally you can take less risk. And so you might want some bonds in there and some shares in there. If, for example, some people just can't sleep at night if their investments go down, it's an emotional thing. That's very valid. And so in that case, you may want less risk. So beyond this, there are some other factors you'll need to consider, but this hopefully gets you on the way in terms of, narrowing down the universe of investments that might be appropriate for you and your child. So we're kicking off the baby prep course next week. If you're in a stage of life where you're thinking about having kids, you're expecting a kid, you're in early parental leave, this is a great course to think about, well, what do the next 12 24, 36 months look like. We do cover investing in more detail. We also cover insurance, etc. So it's a wonderful course. If you're not in this phase of life, then please let a friend know. We also have an article series on our website. It's 5 parts, and I'll include a link to it in the recording, about investing. It's free, you can have a look. And it does go through what do you need to consider when you're evaluating a fund. So there's more information to what we talked about today. So hopefully on that note, I will open it up for Q&A.